Hello everyone. Welcome to our Business Education and Research channel. In today's video, we will present an in-depth analysis of mutual fund expense ratios. In this video, we will explore why understanding and analyzing expense ratios is crucial for selecting the right mutual funds for your investment portfolio. These ratios can significantly affect your returns, and understanding them can lead to more informed investment decisions. Let us start by unraveling the fundamentals of expense ratios and their impact on mutual fund investments. Understanding expense ratios, definition and components. An expense ratio is an annual fee that mutual funds charge their shareholders, that is, unit holders. It represents a percentage of the fund's average assets under management and covers administrative fees, management fees, operating costs, and all other asset-based costs incurred by the fund. This ratio is crucial because it directly reduces the fund's returns to its investors. Calculation method. The expense ratio is calculated by dividing the fund's total operating expenses by the average value of its assets under management. Lower ratios typically indicate a cost-efficient fund that does not eat much into investors' return. For example, if a mutual fund has an operating expense of 2 million and an average asset value of 100 million, its expense ratio would be 2%, that is 2 million divided by 100 million. This means for every 100 invested, 2 goes towards covering the fund's expense annually. Impact on returns. Direct reductions in investments returns. Since expense ratios are deducted from the fund's total assets, they directly reduce the fund's returns. A higher expense ratio diminishes the net profit that investors earn, especially significant in a low return environment. Compounding effect over time. The impact of expense ratios compounds over time. Even a small difference in the expense ratio can lead to a substantial disparity in returns over long investment horizons. For example, for an investment of 100,000 in a fund with 1% expense ratio versus 2% ratio over 20 years, assuming an average annual return of 8%, the lower expense ratio could save investors nearly 50,000 in fees and lost earnings. Comparison across funds types. Active versus passive funds. Typically, actively managed funds have a higher expense ratios due to the cost of research and active trading. In contrast, passive funds like index funds have a lower expense ratios as they simply implicate the market index. Fund size and expense ratios. Larger funds often enjoy economies of scale and can offer lower expense ratios. Smaller funds may have a higher ratios as fixed costs are spread over a smaller asset base. For example, an actively managed equity fund might charge an expense ratio of 1.5% due to active trading and management, whereas a passive index fund might only charge 0.2%, reflecting the lower operational involvement. Legal and regulatory framework. Regulatory caps and guidelines. Regulatory bodies often set caps on the expense ratios that funds can charge to protect investors from excessively high fees. These regulations ensure that fund managers operate within the predefined expense limit. Transparency and disclosure requirements. Mutual funds are required to disclose their expense ratios in their prospectus, offering documents and periodic financial statements, ensuring transparency for investors. For example, in India, SEBI, Securities Exchange Board of India, mandates that the total expense ratio for equity-oriented mutual funds cannot exceed 2.25% of daily net assets value, ensuring investor protection and against high fees. Expense ratios and fund performance. Does lower always means better? While a lower expense ratio is generally preferable, it is not the only factor to consider. Investors should also look at the fund's historical performance, management quality, and investment strategy. Quality versus cost. Sometimes paying a higher fees for active management might be justified by superior returns, especially in niche markets or specialized investment strategies where manager expertise is crucial. For example, an actively managed funds with high expense ratio of 1.8% outperformed its benchmark by 5% annually over the past decade, justifying the higher cost with superior returns. Industry trends shift towards low-cost funds. There has been a noticeable industry shift towards lower-cost funds, especially with the growing popularity of passive and index-linked funds among cost-conscious investors. Technological advancements and cost efficiency. Technology has also played a significant role in reducing operational costs for funds, enabling lower expense ratios and enhanced profitability for investors. For example, the rise of robotic advisors and automated trading systems has allowed new index funds to offer expense ratios as low as 0.05%, attracting a significant investor base focused on cost efficiency. Investor education and awareness. Importance of financial literacy. Educating investors about the implications of expense ratios is crucial for making informed investment choices. Financial literacy helps investors understand how these fees can eat into their potential earnings. Tools and resources. Many financial platforms and advisory services offer calculators and comparative tools to help investors assess and compare fund expense ratios alongside other crucial metrics. For example, financial education workshops that teach investors how to read fund prospectus and annual reports can empower them to make better choices by understanding the impact of expense ratios on their investments. Strategic fund selection. Beyond the expense ratio, while important, the expense ratio should not be the sole criteria for fund selection. Investors should consider other aspects like funds assets allocation, risk profile, and investment horizon. Integrating expense ratios into investment decisions. Savvy investors integrate expense ratios analysis with over evaluation metrics to select funds that offer the best potential for net returns. For example, a financial advisor might recommend a slightly higher cost fund that consistently beats its benchmarks and fits well with an investor risk tolerance, demonstrating a strategic approach to fund selection beyond just cost consideration. Global comparisons. Expense ratio worldwide. The average expense ratios can vary significantly across different countries due to varying market practices and regulatory environments. Benchmarking against global standards. Comparing domestic funds expense ratios against global standards can provide a perspective on whether investors are getting good value for their fees they pay. For example, an analysis shows that average expense ratio for US equity funds is about 0.5%, while in India it is closer to 1.5%. This comparison helps Indian investors evaluate whether they are receiving competitive services for the fees they pay. In this video, we have explored the critical importance of mutual fund expense ratios and how they can impact your investment returns. From direct effects on your earnings to influencing fund performance, expense ratios are a fundamental aspects of investment analysis. Armed with its knowledge, you are better equipped to make informed decisions and select funds that align with your financial goals. Thank you for joining us, and we look forward to empowering you with more financial insights. Thank you.